Thank you very much for that introduction. I think it's actually my pleasure and honor to be here. My first time in Macedonia, and it's an absolute pleasure to be here. I didn't realize it's actually such a beautiful country. So I'm going to be talking a little bit about opportunity and risk and what the III's Microinsurance Working Group is doing in the inclusive insurance space. But maybe just to introduce opportunity risk through a little bit of an analogy. I'd originally planned to do my presentation in about 20 minutes. We've been asked to do it in around about 15. So I guess that opportunity provides a little bit of an upside to you as the audience because you listen to me for 5 minutes less. A bit of a downside to that, though, to yourselves, is that I'll probably rush through it a little bit quicker. So I hope to be able to convey the contents of the presentation, and I hope I'll be able to keep your attention after such a good lunch as well. So just to put it into context, so the map that you see up there in front of you gives you an idea of the state of the actuarial profession across the world. So the dark sort of red-brown color countries are countries where there's a full member association of the IIA, and there's 74 full member associations in total. The light color shows the countries that have an associate membership of the IIA, and there are 26 countries in total there. So I think it's very clear immediately that you can see that the actuarial profession, as you would expect, is concentrated in the more developed countries of the world. And I think quite glaringly, Africa and certain areas, Middle East, Western Asian areas, where there is fairly little membership of the IIA. But just being a member of the IIA doesn't really mean that there's sufficient actuarial skills in a country to develop with, to deal with the insurance issues at hand and the insurance risks. So I've taken a few example countries and looked at a very simple indicator of the gap of actuarial skills being the number of qualified actuaries per million of population. And being a bit biased coming from South Africa, I've taken South Africa as a benchmark where we have roughly 20 qualified actuaries per million of population. And South Africa has a very well-developed insurance industry, a very strong actuarial profession, and also a heck of a lot of inclusive insurance. But if you look at the other countries that I gave as an example, we've heard quite a bit about Kenya today already, being a leader in inclusive insurance. They have around about half an actuary per million of population. And I actually understand from Vladimir that Macedonia has around about 30 actuaries, so that would 30, not 13. So that would leave you with actually doing pretty well in terms of that little indicator of 15 actuaries per million. But I think the point I'm trying to make here is that there is quite a big skills gap in the actuarial side of things, particularly in the markets where inclusive insurance should be taking place and is taking place. So the question is, what do we do about that? And I think one of the big things around that challenge of the skills gap is that it also takes a long time to develop the actuarial skill set and the number of actuarial skills that can actually work in a particular market. And I've just highlighted a few of the issues as to why it does take so long to develop those actuarial skills. Firstly, from an education perspective, it takes a long time to go through that actuarial education process and to actually qualify as an actuary. In South Africa and in many of the other countries that I'm familiar with, you probably take on average 7 to 10 years before you qualify as a fully qualified actuary. So even if we start implementing interventions now, you're only going to take, you're going to see your first impacts probably almost in 10 years' time. Secondly, one of the really big challenges is that in most of these developing markets, there's very limited local actuarial tuition opportunities. In particular, I guess many countries have undergraduate degrees in actuarial science of varying quality, but once a student has left university, there's very, very little opportunity to get a local education in actuarial science and to help you pass the professional exams. There are obviously overseas opportunities in a lot of countries. In South Africa and a lot of African countries, people align themselves with either the US or the UK professions and write those exams. But that's essentially remote education, and there's no local tuition that helps you pass those exams. And then finally, because there are so few qualified actuaries in a lot of countries, those recent graduates who come out of university go into an environment where there are no actuaries who have a lot of experience in that environment who can mentor you and develop the softer skills that are needed in order to help you become a really good actuary. And it's really around the actuarial judgment side of things where I think actuaries add a lot of value. It's around those softer skills, not necessarily the hardcore technical skills, where a lot of the value comes in. So on the one hand, there's this fairly big skills gap in inclusive insurance markets, and it takes a long time to develop the skills and to close that gap. So I'm going to talk a little bit about what the Microinsurance Working Group has been doing in this space. And I'm going to dwell specifically on a particular project that we fairly recently completed. We published in November last year. But I'm going to take you back, first of all, the beginnings of it was in 2014 when the III's Microinsurance Working Group published an issues paper around addressing specifically that skills gap, the actuarial skills gap in inclusive insurance markets. And some of the recommendations coming out of that were quite interesting, including that there should be some form of actuarial education for non-actuaries. So people who have some technical background but no formal actuarial training. And then also actually providing guidance on what is this thing of this proportionality thing, what does it actually mean? And probably the best analogy I have around proportionality is, you don't take a sledgehammer to crack a walnut. It's just, you're going to smash a walnut. Similarly, you're not going to come to a gunfight with just a knife. You're certainly going to lose. So your tools that you have need to be appropriate for the amount of risk that you're dealing with. So the Microinsurance Working Group then set out to start unpacking some of those things, and the result of that was published last year in November, which consists of a paper and a risk assessment tool. And I'm going to basically stand still around that risk assessment tool, but it's in response to the 2014 issues paper. And it's starting to ask, so what are these proportionate actuarial services? And how do you identify the key risks within the inclusive insurance space? What are the actuarial services that are required in this space? And then what level of actuarial skills are required to deliver those services? And as a very simple introduction to the tool, it really provides you with a systematic process that helps you structure your thinking around risk. And I'm going to get into the detail now. But that structured thinking would, we expect, help you to raise risks and, that you probably haven't thought of already, and also to gain a deeper understanding of those risks so that you can manage them better. It also records those assessments in a very systematic way so that you can apply the control cycle to that, and you'll see how that works. And then finally, if you've ever had to go back to a decision that was taken 6 or 12 months previously, you'll realize that if you've got a good record of how you've arrived at that decision, it makes it a heck of a lot simpler to explain why you made that decision. I've often come back and asked, well, how did you make that decision? How do you arrive at that specific recommendation? And if you haven't got that good record, it's going to be quite difficult to do it. But ultimately, it's really important to understand that the tool is only one output that feeds into a broader decision-making process. So the result of using this tool doesn't give you an answer. It provides you with an input where you need to take other factors like your professional judgment, the institutional objectives, etc., into account. And if I can get my next slide. There we go. So how does the tool actually work? So very simplistically, we look at it. There being two key aspects to risk. One is product-driven, the other is provider-driven. Your product speaks to quite a few of the core actuarial issues. So, for example, do you have a large sum assured versus small sum assured? Do you have the data that's available to price your risks? Do you have adequate reinsurance? Are you exposed to fraud, etc.? The provider side of things really looks at the capacity of the insurer to develop a sound product and then to manage that product going forward. So it's really looking at the operational issues. And very interestingly, within microinsurance and the inclusive insurance space, what we find is that more often than not, the bigger risks actually lie with the operational capabilities rather than the product. And that is quite a generalization. We've heard a lot about index insurance and so on, and those are complex products, but usually your inclusive insurance products are very simple, and those simple short-term products hold fairly limited risk. But ultimately, the objective is that the risks within a product should be mitigated until the provider is comfortable that those risks are well enough understood and that they are well enough managed, so that ultimately the risk of that product blowing up is minimized. And it does this by combining, in some way, and I'll get onto that, basically adding together the product risk assessment and your provider risk assessment to get the overall risk assessment. And that's done through a very simple heat map process. So you'll see on the vertical axis, we have a product risk assessment. In this example, we've got a risk assessment that comes out at 2 out of 4 or yellow level. We've also got the provider risk assessment along the horizontal axis, which came out at a 3 out of 4. And your overall assessment is then simply just reading off on your heat map the intersection between the product risk and the provider risk, which in this instant came out at a 2 out of 4 yellow. Now, it's really crucial that before you go through the assessment process, that you've defined what this heat map looks like, and you've also defined where your risk appetite lies. If you don't do that beforehand, chances are good that you're going to be tempted to fudge the result, basically to fudge how you do it, so to get the desired result. Now, the question is how you actually would arrive at each of those 2 assessments. And the little table on the right gives us a simple extract of how this process works. So first of all, we provide a number of risk components that need to be assessed for each of the product and the provider risk. So I've given a few examples that come out of the product risk there being sum assured, data, reinsurance. There are quite a number of other risks that are included there, and that's exactly where the systematic approach comes in. It's effectively a checklist that you can work through in a systematic way to help elicit the types of risks that your product is exposed to. Then for each of those risk components, you'd go and determine what the risk weighting would be. So the risk weighting effectively is a measure of the relative importance of that risk in the context that you're looking at. Once you've allocated a risk weight, you then go and allocate a risk score. So that's essentially a measure of how well that risk is being managed. And I know from quite a bit of feedback already that these 2 concepts, risk weight and risk score, are quite often confused. So I'm going to try and just illustrate using reinsurance as an example of what the difference between the risk weight and risk score is. So for example, if you've got a very simple credit life type product with fairly low sum assured, you'll probably allocate the importance of your reinsurance program is actually quite low. Whereas if you had a fairly complex weather index product or some other disaster product where there's a high concentration of risk, clearly reinsurance is really important. So you'd provide a high risk weighting to that. In terms of a risk score, that's essentially totally independent of the weight that you've done. So if you go back to the credit life example, you may realize when you're going through this assessment that you haven't actually even thought of reinsurance for that product. And you also realize, well, my existing treaties that I have don't even cover this product. That's clearly an indication of a very high risk score because it's just not managed at all. So you can have a case where it's not very important, but you have a high risk score, and obviously vice versa. And really importantly then, to get an overall score for either product risk or the provider risk, we simply take the weighted average of each risk score across the various components. And you do a first iteration of that, and you come out at your overall score by plotting it in the heat, on the heat map. And more often than not, you'll probably see, oops, I'm outside of my risk appetite. So what the process then does is allow you to go back to those risks, those risk components that are the key drivers of that rating, and start unpacking that a little bit further and deciding what are the types of actions that you can take to then mitigate that risk. So that's really just a sort of very high-level introduction into the tool that we've provided. So just some sort of concluding remarks that I wanted to leave you with is that I think it's very clear that there are limited actuarial skills in inclusive insurance markets, and also that it's a long-term project to try and narrow that skills gap. And we need to be innovative in the interim around how we're going to address the lack of actuarial skills. I think the tool that I've very briefly presented here is one of the ways of doing that, and I'd really encourage you all to go and visit the III's Microinsurance Working Group's webpage and have a look at the paper, the tool. There are a number of worked examples there. There are 2 webinars, the live recordings, the presentations that were done. So there's a fair bit of material out there that you can start looking at. And if you have any feedback, I'll be really, really interested in if you do actually use the tool. This is really a work in progress, and we would like to improve it. So if you have positive or negative feedback, as long as it's constructive, I'd love to hear that. And just one final comment is that we've been talking about this in an inclusive insurance context, but this tool is, I think, equally applicable in traditional insurance as well. It simply provides you with that systematic approach of thinking through risk, understanding risk a lot better. Thank you.